Welcome to the Market Moment. My name is Matt Walters alongside Lee Mackey, and we are extremely excited today. Special guest from JPMorgan. We have Hamilton Reiner with us. He's a portfolio manager and head of U.S. equity derivatives at JPMorgan Asset Management. He has been managing U.S. equities and U.S. equity derivatives since 1987 at firms such as Barclays, Lehman Brothers, and Deutsche Bank. He's been at JPMorgan for 15 years. And today we are fortunate enough to have him on the show. Hamilton, welcome. And did I get anything wrong? Did you hear anything that was inaccurate?
It was all very well said and perfect. And thanks for having me today, guys.
Yeah, no, absolutely. Before we jump in, so today's going to be a great just kind of back and forth conversation with Hamilton, learning about what he's doing and what he's got going on at JP Morgan. But as always, before we jump in, we want to remind you to join the online community, the growing community at themarketmoment.com. Like, subscribe, leave us comments, and we'll be looking forward to the comments that we have following up from this conversation. So now, Hamilton, give us a quick, 30 to 60 second kind of background about your role, how you got to JP Morgan and your role now that you're there.
Sure. So real quick, I went to college to be a doctor. After freshman year, I saw blood 4 times. I fainted 4 times. I said, "Hello, finance." I transferred into the business school at the University of Pennsylvania, the Wharton School. And then ever since then, my junior year, I had a class on options and derivatives, and I fell in love. So since 1987, for over 36 years at this point, I've been investing in equity and equity options, as you said earlier. My responsibilities at JP Morgan, I'm CIO of the core platform, but more exciting for me is actually I'm the portfolio manager on our option-oriented strategies, and I've been doing that for over 11 years at this point. And my way to JP Morgan there was an opportunity to really develop and build out these type of strategies within JP Morgan Asset Management. And so from the very ground up is where I started this opportunity and platform.
Awesome. Yeah, and full disclosure, before we kind of get into the strategies, we're personal investors. We use some of the strategies and funds that Hamilton runs in our client portfolios, like HELO and JEPQ. We've used JEPI in the past. I know JHQX was another one that we've used previously. So kind of full disclosure there. So jumping into kind of that hedged equity space, specifically with like HELO, I know that came out, was it September of last year? So
Yes.
That was the ETF. I was looking at it this morning. It looks like you're approaching like 900 million in assets. Is that about right?
It's growing and growing quite nicely.
Yeah.
It's just under 900 million at this point.
Awesome. So tell us a little bit about some of those strategies that you manage and why you think they've become so popular and we've seen such growth in those.
Sure. So investing is hard. It's never easy. I mean, whether it be the markets at all-time highs, fixed income's more volatile than it's ever been before, as far as you're seeing these 10, 12, 15 base point moves. Fixed income is not showing to be negatively correlated with stocks. So investing's hard. And when I think about these strategies that use options, number one, for us, it's never about leverage. When oftentimes I tell people we use options, they immediately think that we use leverage or I believe in leverage. A, I don't believe in leverage, and B, we don't use leverage. Excuse me. So these strategies are designed to have less volatility and beta in the market. These strategies are designed to have a better Sharpe ratio in the market, a positive up-down capture relative to the market, and deliver outcomes. So a strategy like HELO, hedged equity laddered overlay, so yes, don't say goodbye to your stock, say hello, is about helping clients own more stocks, navigate these challenging environments. And that's kind of why we created this. We were one of the OGs in over nearly 11 years ago in creating this hedged equity space, because the fact is 2008 was traumatic to clients' portfolios. People got crushed. Mm-hmm. I mean, I worked at Lehman Brothers. Believe me, I got crushed. And then, there was 3 types of clients in 2008. The first one were the ones that said, you know what, just get me out. I can't handle this. Down 36% in my equities is I just can't stand it. The second one were the ones that found religion. God, if I ever get back to flat, I promise I'll get out. And then the third ones, I said, you know what, steady the course. But then the summer of 2011 happened where the U.S. debt got downgraded and the markets went down 14% in a 2-week period. And then that last group of people, a bunch of them just pulled the trigger and said, I'm out. And so a strategy like HELO or a hedged equity strategy is about helping people own more stocks, get invested, stay invested, and not worry about the wiggles and the waggles. Mm-hmm. So that's kind of how we think about HELO.
Okay. I was fortunate enough to hear Hamilton, a couple months ago in New York, and as Matt said, we own a number of your portfolio, the portfolios you run in our models. Hedged equity, the mutual fund, has been one of my personal favorites for a number of years, even before I came here to Mach 1. So let's talk about hedged equity, and then let's talk a little bit about HELO and the subtle differences in those two different holdings. So why don't you talk to us a little bit about the premise in hedged equity, and then kind of how it relates to HELO.
Sure. So first and foremost, we start with basically, what is hedged equity? It's going to sound obvious, but it is an equity portfolio that hedges. So we start at the center of the strategy with a long portfolio that's designed to look like the S&P 500, but be slightly different to generate a little bit of alpha over time. It's actually a long portfolio we've been managing for over 35 years. And so we start with an underlying long portfolio that looks, smells, and tastes like the S&P 500, but it's going to have between 150 and 225 names. And it's going to have very low tracking error, less than 150 pips annualized tracking error. And then around that, we're going to hedge. And the hedges we put in place are on every 3 months and stay on for the full 3 months. We don't time our hedges. I don't believe in timing our hedges. Those hedges are from down 5 to down 20 every 3 months, no matter what, whether I'm bullish, bearish, or neutral. But one of the historical challenges with hedging is you hedge and nothing happens. You hedge again and nothing happens. You hedge again and nothing happens. What happens the fourth time? You don't hedge and something happens. So you need staying power. And the way we have staying power is we'll sell an out-of-the-money option call to pay for that downside hedge. That way the hedge pays for itself with inside the strategy. And most importantly, it gives you staying power. You don't have to worry about market timing, because market timing, even getting it right 9 out of 10 times, is not profitable. The one time you get it wrong, you give back everything you made the other 9 times. So think about this strategy as, that first 5%, sort of like being your deductible. The market's down 2, we'll be down 2. If the market's down 3, we'll be down 3. And clients are okay with that, because you're not really worried about the little doinks, if you will. Right. You're worried about something more significant happening. Now, one of the nice things about doing a hedge every 3 months is as the market drifts higher, my hedges drift higher. So we're always resetting our hedges from down 5% from where the market closed at the end of the quarter. So it acts like a trailing stop. It's kind of a neat feature. More importantly, it gives you the ability to protect a lot of what you made up to that point and reparticipate with more upside. With more upside. So in an upwardly biased market, it gives you a chance to protect and reparticipate. What if the market goes down? Like it did in the first quarter of 2020. The market was down about 19.63. And we were down just less than 5%, as expected. Well, I took the winnings of our hedges and I reinvested at a lower level, like dollar cost averaging. So this 3-month hedge is truly an elegant solution. But one of the things that we saw was that many people would wait to the very last day of March or June or September or December when we first launched. And we wanted people to give people the opportunity to invest at any given point in any month to get that pure down 5 to down 20 experience. So we launched Hedge Equity 2 and 3, which are identical, but are separated at birth by a month or 2. So think about Hedge Equity being January, February, March, Hedge Equity 2, February, March, and April, and Hedge Equity 3, March, April, and May. That way you don't have to wait to the end of the quarter to invest. And we see people using them together individually. Over the long term, you should not see a difference among the 3. Mm-hmm. Now, HELO is about helping people not have to combine all three. It's a laddered and staggered approach. Still using 3-month hedges, but base case using a third, a third, a third in all three of those different hedge windows. So you're never fully capped out, and it gives you a more consistent beta. But we have some clients that say, I want to know with near certainty if the market's down, we're only down 5% over a 3-month window. And that's a hedged equity mutual fund client. But for that client that says, you know what, I never want to be capped out, but I always want to lose less if and when the market goes down, that could be a HELO client. So the reason we launched it as an ETF was many people said, we love the ETF wrapper, check the box. We have many people say that I like combining your hedged equity mutual funds, but even though I love JPMorgan, I don't want to have too many lines associated with JPMorgan, and this eliminates that. You also have the ability to say, which one do I buy? Do I buy hedged equity? Do I buy hedged equity 2? Do I hedge equity 3? HELO actually eliminates that conversation. Now, the mutual fund has been tax efficient since inception. The ETF, because of the ETF wrapper, will enable it to be even more tax efficient because I do have things, ability to defer taxes by the mechanisms that are available to me inside the ETF wrapper. So HELO, I would just say, is another extension of the hedged equity series that we've launched.
How does it compare to some of, buffered ETFs, are, there's a new one every week, it seems like. How does HELO compare to other buffered ETFs?
So I respect my competitors in the buffered ETF space. I do, because anything that can help clients own more stocks but in a more defensive manner, I think has value. So I would say the key differentiators are this. Number one, dividends. Dividends matter. Sure. Almost all the buffer ETFs take your dividends to pay for their hedges. And if you go back in time, just the last 10 years, the S&P 500 price return is up, I think, about 150, 160%. Total return, including dividends, is well over 200. It's about 2% per year. So dividends matter, and we're one of the few strategies that will give you dividends. And if you think about it, between dividends and fees, in many of those buffer strategies, you're starting 1.6% in dividends plus the fees in the whole relative to the total return. Second thing I would say is expenses. Our expenses tend to be to the buffer strategies anywhere from 30 to 50% less. So we tend to be more attractively priced. And then active. Our long portfolio has added alpha over time. Last year, our long portfolio was over 200 bips of alpha, and this year it's over 100. Alpha will come and go, but our consistent, long portfolio that's active tends to be, a nice added kicker. And then the length of our hedges. Our 3-month hedge is, unique and differentiated, giving that trailing stop. I think many of the buffer strategies, some of the most popular ones, actually do 1-year hedges. So I would say those are some of the key differentiators.
Yeah. And so we've been big believers in hedging, using options to manage risk for a long time. We've utilized SMAs for 10 plus years, kind of, implementing the same kind of hedged equity approach. What would you say? We get this question a lot. I've gotten it many, many times over the years. So a client will come in and say, so you're telling me I can own more stocks, manage risk. Like, why doesn't everyone do this? Like, what's the downside? What's the negative with hedged equity? If I can own more stocks, but also limit my downside and manage the downside risk, why isn't everyone doing this?
Because at the end of the day, first of all, I think it can fit in many clients' portfolios, but not to say it's for everybody, but could fit in many people's portfolios. The first thing I would say is, as an equity allocation, there is going to be some downside. It will be less than the equity market over time, but there is some downside. Number two young guys like you should not be hedging. You should be all risk all the time.
Right.
The power of compounding, whether you're attributed to Buffett or Einstein, is incredibly powerful. And we'll talk about that in a second. But there are some people that don't own enough stocks, and they should be using a hedged equity portfolio. There are many people that have ridden this market long and strong and want to take some chips off the table. They should be a hedged equity client. But to say that it's going to replace your equity allocation, it can't be done because you need some of that beta 1 equities. But as you know, there's some people that should be 40% stocks. They're only 25. They should buy hedged equity. There's some people that are 50 that should be 65. They should own hedged equity. But let me bring this to life for a second. This is a cool stat, I think. If cash is not trash, and there is income and fixed income, and if I could guarantee your listeners 4.5% on their cash for the next 30 plus years, $200,000 is $800,000 in just over 30 years. That's pretty good. If I can promise them, and I can't, if I can promise them 9% on their equities for that same period of time, just over 30 years, that same 200 grand is $3.2 million, a difference of $2.4 million. So if a hedge equity strategy gets them out of cash into something that's more like stocks, the compounding effect is incredible. So to your question, you should be doing more of it. You should not have too much cash on the sidelines unless you need it for liquidity purposes. But so I do think there's a lot of value in getting people into the equity market, either all in or with guardrails.
Mm-hmm, sure. So kind of switching topics just a little bit. So you've got a couple other funds that you run, JEPI and JEPQ, somewhat relative new ETFs, I believe. Tell us a little bit about the features and kind of what you're trying to accomplish there.
Sure. So when I think about JEPI and JEPQ, when we first launched them, we really thought it was a great way of giving clients above average level of income without duration risk and without credit spread risk. But call overriding is nothing new. I mean, you kind of told your audience how old I am by how long I've been doing this since 1987. But the fact is, people were doing call overriding well before I even started in the industry. So I took all of my experience from since 1987 till today and said, what are some of the best things around call overriding? And then what would be some of the things that I would change or alter? So let me bring one to life. If the three of us were a investment committee and we worked really hard to find our favorite stocks, and then we sold calls on those favorite stocks, we'd end up in this perverse relationship where we start rooting against these stocks going up. I hope the stock does not go up too much because I don't want to have it taken away from me. Or you end up having your winners taken away from you, you're left with your losers. Mm-hmm. So what we want to do is we want to give you income and reduce beta, but never have our stocks taken away from us. So we do options at the index level. That's a key distinguishing feature. The next distinguishing feature is it's not what can go right, but rather what could go wrong. And if you own the index, if the market goes down, the only thing protecting you on the downside is the option premium. So we want to have in JEPI a more defensive, higher quality portfolio that would help in most market circumstances eat less of the downside if when the market's sold off. So think about JEPI as being a well-diversified by name and by sector, because we aren't market cap weighted like the index. We're just going to own a group of fundamentally attractive, higher quality names. And we don't care if they pay a dividend or not. As of right now, as of the recording of this conversation we're having, we own Amazon. Amazon does not pay a dividend. Why do we own it? It's a great franchise. And when markets go down, it probably would go down less. So think about JEPI as a strategy that's going to have about 2/3 of the volatility in the beta of the S&P 500. So less volatility, less beta. 7 to 9% distributable income through a cycle. Owning a high quality group of portfolios that is selling options at the index level, so we never have our stocks taken away from us, out a month in time. And always, this is very important, always out of the money. Because we want to give you some of the upside as well as some of the income. It's about balance. For me, investing is about balance. And then with JEPQ, we thought it was a very unique opportunity to put 3 phrases in a sentence that never get mentioned in a sentence. Growth in tech, less vol and less beta, and income. Think about that, guys. When was the last time you heard somebody talk about growth in tech and income in the same sentence? Or even less volatility and less beta? So JEPQ is about having a underlying long portfolio that's going to resemble the NASDAQ 100, which, as you know, is a little growthier and a little techier. The options that we sell are at the index level, the NASDAQ, and it's going to give our strategy 25% less volatility and beta than the NASDAQ 100 through a cycle, with through a cycle about 9 to 11% distributable income. Now, when we first launched these strategies, I really felt as though our predominant investor was going to be an income-oriented client. But what we've seen is that that's about 60%. It's about 40% of the people that actually say, you know what? I like your higher quality names that you own in JEPI, and I like the ability to have it throw off some income. So I get multiple ways of winning. I have some dividends, some options premium, and then some of the upside. So even if the market were to be in a range-bound market, you still could do okay because you're still getting the dividends, the options premium associated with the long portfolio. It's not win or lose. Market goes up, I win. Market goes down, I lose. And then with JEPQ, there are many people that would like to own growth in tech, just can't handle the volatility. So we see many people using JEPQ not just for the income orientation of it, but as a way to own, those little more techy and growthier names that are in the NASDAQ 100, but doing it with less volatility and less beta through a cycle. So we see multiple use cases here, either income-oriented clients or that more conservative client that just wants a more conservative way of getting some equity market exposure.
And then you throw in hedged equity, HELO, and then you have a pretty nice diversified portfolio all the way around between those three.
So you bring up a good point. So 90% of my net liquid assets are in the strategies that I manage. So I definitely eat my own cooking. Combining JEPI and JEPQ, 40% in JEPQ, 60% in JEPI, will give you something that looks a lot like the S&P 500. So we have some people that say, I like owning JEPI, a higher quality portfolio. We have some people say, I want to be growthier in tech here, so I want to own JEPQ because I don't have enough growth in tech in my portfolio. If you have enough growth in tech, probably should think about JEPI. Or we see people say, I want to stay in the middle of the fairway. 40% in JEPQ and 60% in JEPI will look a lot like the S&P 500 from a sector allocation. Mm-hmm. And I'll have about a 0.7 beta to the market. Hedged equity through a cycle, we would expect, and HELO as well, to give our investors half the vol and half the beta of the market and about 2/3 the market return. So my personal portfolio is about half hedged equity, about half JEPI and JEPQ in that ratio. Because if you have 0.7 and 0.5, what do you get? 0.6. So my personal portfolio is about a 60-40 without the 40. Do I dislike fixed income? I don't. I just don't like it for me. Mm-hmm. So but there's two reasons people tend to own fixed income. Number one, for income. And number two, for that hopeful diversification. Well, I don't have to hope I get diversification because I have a high level of confidence that when the market goes down, S&P 500 puts are going to kick in. So it gives me that true hedge that many people seek. Number two, income. Excuse me. With JEPI through a cycle 7 to 9 and JEPQ 9 to 11, that combination we expect to give our investors 8 to 10% through a cycle with that 40-60 ratio. So you're going to get right now over 4.5% income, which would be more income that you would get in the 40. So I'm not anti-40. It's that I can replicate in many cases by putting my strategies together. Mm-hmm. And the reason I highlight that, guys, is it's not either or. These strategies actually play nice in the sandbox together because their returns complement one another.
Sure. Okay. Yeah. So we're getting close to the end of our time with you today. Really appreciate you jumping on. But real quick, kind of give us I won't ask for your end of year S&P 500 price target or anything like that, but give us some thoughts on where you think the market's at, and as we look forward to kind of the back half of the year.
Yeah, so I don't have an S&P target for you, but what I would say is you've never been rewarded for being underweight stocks. So with your guys' partnership, your listeners and your clients should at the very least be at a target allocation in equities. Even in a challenging year like 2022, in 2023, you got it all back. So if the market, sells off and we're all happy because we're underweight stocks, they probably aren't going to get back in time. So my personal belief is be at your strategic allocation. And if you want to be a little frisky and be a little bit over, then get it in something like a HELO, Hedged Equity, JEPI or JEPQ, because you're doing it in a more conservative manner.
Right. Yeah.
So I kind of feel like the markets are okay here. The Fed has a Fed put now. Earnings are okay. I think the narrowness of the rally we've seen year to date is actually bullish because there are a lot of great companies that are only up modestly, that had their earnings grow over the last year or two or three, and have the ability to participate if the market rally expands to more than the fabulous four, AI, tech, whatever you want to call it. So I'm pretty constructive. I think the worst thing you could do is just be on the sidelines waiting for a pullback, and you have to find a way to get that money to work.
Yeah. Absolutely. Any final questions?
No, we appreciate it. I know your time is valuable. You're busy. So we appreciate you jumping on here and educating us, but also educating our viewers and clients that watch this. So we really appreciate it, Hamilton. Thank you.
Yeah, we appreciate partnership with JPMorgan and the products and strategies you guys put out, and look forward to seeing what you guys do in the future. And always fun to keep up with what y'all have going on. So appreciate your time.
Thank you very much.
Thank you guys for having me, and appreciate your partnership.
Absolutely.
Wonderful.
Absolutely. Thanks, Hamilton. All right. Well, as always, we appreciate you guys listening, and give us a like, subscribe, and we will look for your comments and see you guys next week. Thanks.